Welcome everybody to the tax plan. We're going to talk about all sorts of expert strategies so that you can keep as much of your hard-earned income as possible. Today, we're going to be talking about one of the cornerstones of investing and tax planning, and that's capital gains taxes, capital losses, and how to maximize your capital gains and investments to save as much on taxes as possible. We're going to start with a breakdown of when you pay capital gains, how do you calculate a capital gain, and how does that apply to your investment portfolio, or maybe even some alternative investments that you might have accumulated throughout the years. A capital gain is the sale that you make of an asset you own above the price you paid for it. That's the simplest terms. Now, there are some complexities, and we'll talk about a couple of them in terms of what might change your basis, what might affect the sale price, but at its core, what you sell something for minus what you originally paid for is how much your gain is that you're going to pay taxes on. So let's say I buy a stock in ABC company and I pay $100 for it. It appreciates. It was a good choice that I made that stock purchase, and in 3 years that stock is $150 and I sell it. I have a $50 capital gain because I paid $100 and I sold it for $150. Simple, right? That's the cornerstone of how capital gains work. Now, there's one really big kind of huge factor in capital gains taxes in particular, and that's whether your gain is a short-term or a long-term capital gain. And the definition between the two is very simple. If you've owned the asset for more than a year when you sell it, it is a long-term capital gain. If it's something you bought and sold within a year, it's a short-term capital gain. So this really becomes a huge kind of factor difference when you talk about a portfolio that's actively managed by day traders. There's going to be lots of short-term capital gains, and that's part of why investment companies like hedge funds or aggressive day traders, they're trying to reach returns that are significantly above the market because, as we're going to learn very shortly, short-term capital gains are less preferable tax-wise than long-term capital gains. So there is an incentive to maximize your long-term capital gains, and other than obviously missing a window where a stock has spiked and you expect the market to go down, you don't necessarily want to keep stocks that you think are bad investments just to save on taxes, but as much as you can control and plan for, the more capital gains you can keep for a year and pay preferable tax rates on, you're going to save a lot of money. So let's talk about what that difference is, because it's very significant. For short-term capital gains, there's no difference. So for short-term capital gains, it's just income tax. It's taxed at your normal income tax federal bracket. So if you are in a 20% marginal tax bracket and at the end of the year you sell something in December that you bought in October, it's a short-term capital gain. You've had your W-2 wages, whatever, throughout the year, and you're in a 20% bracket. That gain on that sale is going to be taxed at 20% because that's your marginal tax bracket. So there's no real differentiation in terms of how much tax you pay between capital gains and income if those capital gains are short-term. Now let's talk about long-term capital gains, because this is where we actually start planning and why there is such a big difference between a long-term capital gain and a short-term capital gain. All right, so long-term capital gains are taxed at one of three rates depending on your income for that tax year. Those rates are 0%, 15%, and 20%. If you're wondering if the first rate that I said was 0%, it is. You heard correctly, 0%. And that becomes kind of the fundamental tax plan of capital gains is how do we pay 0% on our capital gains? I think everyone with any sort of income or portfolio wants to hear that number. You're going to pay nothing on your taxes for this gain or this income, right? That's the goal of tax planning. Assuming you're not in some situation where you're trying to show high income for a year because you're trying to get approved for a home loan, and so you're incentivized to kind of not fraudulently overstate your income, but you're not necessarily trying to maximize your deductions because you want to be in a high income bracket so you can qualify for a business loan or a home loan or something like that. But most people, especially in retirement, we are trying to minimize taxes. So yes, you can pay 0% on long-term capital gains, and it's not necessarily super difficult to do so, and we're going to help you plan for that by breaking down the rates and understanding how we can maximize that 0% rate. So if you hear those brackets in general, even before we get into how to really maximize that 0% rate, this episode, you could probably already kind of tell, is for anybody. If you are someone who is not ultra high wealthy, but you're a moderate retiree and you're just trying to maximize your situation, 0% is great. That's the goal. We want to keep all of our income, especially in retirement, where for a lot of people, we hope we've built wealth, but even still, your income and your cash flow for a lot of people is lower than it was when you were working, especially right before retirement, where most people kind of are in their best position before retiring, right? They've worked their whole career to work up to something. But also, if you're ultra wealthy, 15% is a heck of a lot better. Even 20% is a heck of a lot better than the top marginal ordinary income tax bracket, which is 37%, right? So regardless of your tax bracket, there is no level of wealth you can reach where this concept is not a fundamental, incredibly important concept for retirement planning. And this is kind of, I'm not going to get political here in terms of whether this is a good or a bad thing, but when you hear kind of social narrative about the rich not paying their fair share, you'll often hear this person paid 0% in income tax. They're not paying their fair share. They're worth billions of dollars. What is often left out of that narrative is that they are probably paying a lot in capital gains taxes, because for a lot of the ultra wealthy individuals, especially we're talking some of the most wealthy people in the world like Elon Musk or Mark Zuckerberg or Jeff Bezos, we're talking about people who almost their entire portfolio is their ownership in ultra successful multi-billion dollar companies. So when they sell stock in their companies, for example, when Elon Musk sold the big shares of Tesla to buy and acquire Twitter, he's paying capital gains taxes. So the most he can pay is 20% because that's the highest bracket. So we can see how this is a tool for the ultra wealthy and also one of the most important tools for the not very wealthy, because you can be paying 0%. So it's so fundamentally important. And let's talk about what those rates are now and kind of break it down a little bit more specifically. For individuals who are single, here are the tax rates. You will pay 0% if your income is below $47,025. If you're married, you'll pay 0% on $94,050. That number is higher than what a lot of people think. And we just got a text from a client where they said, am I reading this right? If I can keep my income below just under $100,000, if I can keep it below $94,000, I don't pay any taxes. We said, yeah, that's exactly true. So this is a very important tool for retirement. And a lot of people in retirement can live off of less than $94,000 a year. And if you can't, here's the great news. Pay 0% on most of your income, and then you might have a little bit of those capital gains that are subject to 15%. That's still very livable. It's better than being in the six figures and paying 20% or more for ordinary income tax brackets. So absolutely important. Here's kind of the even cooler thing for a lot of people who are retiring, who are looking to an advisor, and they might have built up a little bit more wealth in their retirement. The rate between 0 and 15%, meaning you're not paying 0, but any of your capital gains above this number, they're taxed at 15%. For single people, that's everything above 47, but up until $518,000. And for married, it's from $94,000 to $583,000. So these are really high limits. For 99.5% of our listeners, they're never going to have to think about the 20% bracket. Trust me, we wish our client portfolio was consisted of people who in retirement through capital gains can sustain income of over $600,000. That means you have done very well. We would love to work with you. That's a very small percentage of the population. For the vast majority of people, a lot of you are at that 94 and less, and that's great. You can make almost six figures in retirement and you can pay 0% in taxes. But even if you're above that and you're a little bit more wealthy, we can get you up to $583,000 if you're married and you only pay 15%. So super favorable tax brackets when we talk about capital gains. So let's talk about retirement planning and how to utilize these. An important concept to understand with these capital gains is capital gains are subject to their own tax bracket, as we just talked about, 0, 15, or 20%. But the calculation of those income limits, like the $47,000 number we talked about, the $94,000, those are for all of your income. So this is where it gets a little bit more complex. If I have $20,000 in interest income, and then I have $80,000 in capital gains, long-term capital gains, okay? My total income is $100,000. So even though I only had $80,000 in capital gains and I'm married, my total income is $100,000, therefore I'm $6,000 above that 94 bracket change from 0 to 15%. So $6,000 of capital gains will be taxed at the 15% rate. So hopefully that crystallizes it there. You're calculating all of your income, the income that you have on your tax return. That's going to determine that threshold of, am I in 0, am I in 15%, or am I in 20%? But it's only applied to the capital gains because in this scenario, that interest income, well, that's subject to ordinary income. So it does get complicated. And for those of you with long-term capital gains, you end up with two separate tax rates. So your capital gains, your long-term capital gains are subject to the capital gains brackets, and your income is subject to the ordinary income tax brackets, but they're calculated together. And on your tax return, you'll see total income, you'll see adjusted gross income. Those will include both. So you're kind of paying two different tax rates and taxes on one income pool. But obviously for most people, these long-term capital gains taxes, they're a lower rate than the same comparable income of ordinary income tax rates. So what does this mean for you in your retirement planning? Your goal is really this: to balance your risk tolerance with your tax savings, because now let's kind of contextualize all of this to a person in retirement. You want to pay taxes as much as you can on long-term capital gains. You don't want a ton of interest. You don't want short-term capital gains. You don't want, real estate income, whatever. It's passive, but it's still income, and it's taxed at ordinary income tax rate. So you want long-term capital gains rates. But if that's your entire portfolio and the sole way that you generate income in retirement is selling stocks from your portfolio little by little to keep an income stream coming, hopefully not selling so much all the time that you're chipping away at the principal, but you're trying to work with your investment advisor, your retirement planner, to create an income stream that's sustainable by your principal in your retirement plan. You like the taxes of the long-term capital gains, but you're now a little bit more subject to the swings in the market because you're not having a lot in treasuries where you're guaranteed by the government 5.1% right now on 3-month treasuries. You aren't having other fixed income securities. You don't have as much rental real estate where you can kind of count on tenants paying the fixed rental amount every month, right? So your income now, well, what if you're retired and you retire in December of 2019 and it's February, March of 2020, and you've agreed with your investment advisor, you're going to bring out $7,500 a month in capital gains, and that's going to sustain your retirement. Well, COVID happens in March of 2020, so now your entire portfolio took a 30% dive. It's not really wise to sell at that point. If you just wait 6 to 12 months, it's going to rebound, but you're reliant on that portfolio for income. So you can see how, while not necessarily, there's lots of ways to build a portfolio that protects against balanced risk, that's diversified, that you can use to hedge against this type of risk, the market risk of your portfolio. That being said, having a huge portion of your income in long-term capital gains does just mean you have to be a little bit more mindful of the market in general, because you're relying on constant stock sales to sustain your lifestyle. And so that means that you're trading maybe more often on a monthly basis, or maybe your investment advisor, you trust their judgment. They make a larger sale every quarter when they think certain companies are at a good peak, and you plan that way. That's also great. But just know that you are a little bit more subject to market changes when you're relying on these long-term capital gains to sustain your income in retirement. But there's no greater tool to save money and to pay as little taxes as possible in retirement than maximizing the amount of your income that is a long-term capital gain. Let's talk about one more quick thing real quick. You can also utilize this in years where you don't have a lot of income to what's called reset your tax basis. And here's what that means. I just retired. I have some money saved in the bank. I don't need a lot of income. So what does that mean? Well, I have $94,000 theoretically that I could have gains on and not pay any taxes. So I'm going to utilize that in this year when I have very little other income so that I can maximize as much as that 94. And remember, 94 is the amount of long-term capital gains you can have without being subject to taxes, not the total amount of the sale price. Remember, the gain is the sale price minus the basis. So if I have a bunch of stock that I sold for $50 or that I bought for $50 and now I'm selling for $100, I can sell double 94,000, right? Because if I'm selling, what's double? $188,000 in stocks. My basis is 94,000 because I bought for 50, I'm selling for 100. Therefore, I can sell 188,000 in my stock. My gain is only 94 and I pay zero taxes. Well, what does that mean? I have $188,000 in cash. I just made a sale. I don't have to pay any taxes on that sale. What if I liked that investment? Awesome. Immediately rebuy it at the same price. What did I do? I now upped my cost basis from $50 to $100. And now down the road, when that stock in 10 years is $150, well, now, again, I'm only paying $50 per stock when I sell, where if I had just held this investment the entire time, there's a lot of years in that window where I wasn't necessarily maximizing up to that 94,000 in order to create as much tax-free sales as I could, right? And now the stock's 150. I've never sold. It was a long-term hold. I'm at $50 still in my cost basis. So what happens when I sell? I pay $100 in gain on every single sale. So this is something that if your advisor has not talked about at all or has not been recommended, you need to be talking to your advisor about this. If your income is not at $94,000 and you have in your portfolio investments that are considered a long-term hold, meaning your investment advisor has said, look, this is not an up and down. These are blue chip stocks. This is Apple. This is Microsoft. We're going to hold this forever. We can count on it, consistent growth type of stock, or it's a very aggressive growth stock. And we're saying, look, this is going to have super highs and lows, right? But we believe in 10 years, this industry is going to blow up. So we're holding this long-term as an aggressive growth option as an element of your portfolio. You don't have to sell overall the stock, but if your income for the year is $60,000, what does that tell you? You have $34,000 of cushion that you can sell and have a gain on stock and pay zero in taxes, right? So sell those stocks, rebuy immediately within the same 24-hour period, okay? And now you've reset your basis to the current price. So now long-term down the road, you're going to have a lower capital gain because you've utilized these years with lower income to reset your stock basis in stocks that you've accumulated a high amount of gains on, and you've now future planned very effectively to pay as little taxes as possible throughout retirement and upon your death. And speaking of death, to end on a morbid note, this is the last thing I want to talk about. There is something called a step-up basis. What that means is If I buy a stock for $20 and it's 80, I die at 80 and I bought it 50 years ago. And when I die, it's $150. That would be $130 per stock. That's a 500 something percent increase, right? In that stock's value. That's going to be a huge gain. Don't sell that if you are planning on leaving a portfolio to your kids. If you're going to die with a retirement account for your heirs, your kids, your siblings, your cousins, whoever you want to leave your money to, leave high margin gain accounts without selling before death, because here's what happens. Stocks are one of those things where when you die, the inherited value is considered the basis to the person you leave it to. So in the case of this, I buy at 20, I die 50 years later, and I leave it to my son, and it's $130 when I leave it to my son. His basis is $130, not 20. So now when he sells the stock, he gets to subtract the 130 from the sale to arrive at his capital gain, not the $20. So because stocks are subject to a step-up basis when you're legacy planning and you're planning on what you're going to leave to your heirs, having a high amount of accumulated net worth and accumulated gain on stocks that you've held for a long time and they've massively appreciated, your heirs are going to get a step up in basis on those stocks, which is going to hugely increase the basis and therefore lower their capital gain down the road when they eventually sell that stock. Hopefully, this episode has taught you a lot about capital gains. Let's do a quick recap on how this planning can help you. If you're married and you have less than $94,000 in income, long-term capital gains give you a 0% tax planning tool. If you're wealthy and you have more than that, the 15% rate up to $583,000 is going to massively lower your tax bill by not paying up to a 37% ordinary income tax. Remember that in your retirement account, you can readjust basis and you can buy back into a stock by utilizing up to that $94,000 to sell stocks that have a large capital gain on them. You're below 94, so you don't pay any capital gains taxes, and then you buy the stock right back to increase your basis. That's a tool that you can utilize. And then lastly, we've talked about legacy planning. When you pass away, the stocks that you leave to your heirs in an investment account, they get a step up in basis where the market value of them at the time of your death becomes the basis for the new heir. So that's a really great way to legacy plan and leave a lot of value and lower capital gains all the way to the next generation by making sure that you didn't sell and create that gain and those taxes paid out of your estate. You kept the gain there, you let the stock appreciate, and you let your heirs receive a step up basis when they inherit that wealth. Thank you for listening. As always, please leave comments on the videos or reach out to us individually if you want to hear anything, future topics that you want covered, even just questions that you want answered in the next episode. We want to help you save as much of your money as possible and pay as little of it to the government as possible because you worked hard for it and you deserve it. Thank you for listening to The Tax Plan, and we'll see you next week.